We'll be talking a lot about Kenya Airways, which will be announcing the results later this week, and a little bit on Mumias Sugar, which has received a capital injection from the Kenya Sugar Board. But before then, let's have a look at the currency, which held steady on Friday to close at 84.8085, which was the same level that it closed on Thursday. Crossing over to the Nairobi Securities Exchange, we saw the main share index dropping half a percentage point to 4,962.66 points, while the all-share index was down also half a percentage point to close the week at 126.19 points. With us in studio, we have Evans Mugi. He is an investment analyst with Centum Investment. Many thanks for joining us.
Thank you.
Now, we've seen reports coming in yesterday that Mumias Sugar is going to receive a capital injection from the Kenya Sugar Board, and this is on the back of the company having a lot of cash constraint. And it's also a company that had also earlier said that they're likely to have a rights issue to raise some capital for one of the projects they have at the plantation, that they want to have some more cane. For you, what are some of the sentiments that you're drawing from the squabbles in the cash-strapped company that you're seeing with Mumias?
I think if you look at the history of Mumias initially and the sort of investments that they've been doing over time, we find that the biggest constraint really has been the return on the investment capital. So they've actually been running one project after the other and not really giving projects enough time to take off and start to contribute positively to the top line. So I think the issue of the capital injection is really good, because I think the rights issue would probably have been undersubscribed unless they would have managed to price it fairly attractively, which would have been impacted negatively on current shareholders. I think going forward, the key thing would be how new management actually is able to manage the company going forward. But the sugar industry, in terms of margins, not very attractive. If you look at the competitors across the African landscape, so you have Dangote Sugar in Nigeria and Sugar Company in Egypt. I think Delta Sugar, that's the name, Delta Sugar. I think if you look at the multiples compared to Mumias, you see that there may be a bit of value, but just the industry dynamics are not attractive.
And of course, you have a Mauritian company, Omni Sugar, I think, which is also coming in Kenya. Yeah. How competitive is Mumias Sugar?
How competitive is Mumias Sugar? I think they've benefited really from the fact that they've had some sort of buffer built in with the EAC market protocols and the sort of protection that they have enjoyed over time. The question has always been whether once those sort of restrictions or quotas were lifted, how the company could run from there on, and that was the rationale behind going into the diversification. I think you may find that actually a more attractive business model might be to just rely on cane sourcing from other geographies, like for example Brazil or Mauritius itself, and maybe do some sort of just a slight value add, little value add, and just distribute that within the market.
Was it too early for them to think of going to diversify to other products like bottling of water, ethanol, yet they had not quite streamlined their own core business? I
think the very fact that they were actually diversifying was very telling in terms of what management thought of what we are calling their core business, which was just the processing and sale of raw sugar. I think the diversification was needed. It was something that it was an idea whose time had come, but ideally the way they went about it was obviously going to constrain their cash flows, number one, and before you actually started to see some positive contribution from these projects based on their life and the sort of market that they were targeting, it was obviously going to be of detriment to the shareholders, and I think we've seen this over time.
The fact that they've not even had an update with regards to the cash call that they were planning to have, the capital raising venture that they have been talking about for some time now, and this year they've gone quiet. Is that an indication that probably they're not yet ready to come into the market and look for capital?
I think it was more an issue of at what price would they come in, and at what sort of discount they would have to price whatever rights issue they were doing, and how that would be received by the market. I think the basics remain the fact that if your return on equity is lower than your cost of equity, then over time basically what you're doing is destroying value for shareholders. I think anybody who's looked at the company can see that actually that is the case, and I think then it would have been very unattractive for them to come and price in. They could have benefited if the share price had reacted positively to recent market movements, but I think Mumias has really struggled compared to other stocks. If you look at your agri stocks and the consumer stocks in the consumer staples sector, Mumias has struggled, and I don't think that a rights issue would have been well received at that time.
And of course, it's a stock that has been trading under 5 shillings for the couple of months now. All right. Looking at Kenya Airways, it's going to announce the results later this week on Friday.
Yeah.
And this is a stock that also has been fluctuating and now have also been underperforming if you can look at it from the perspective of the other blue chips that are listed in the Nairobi Securities Exchange.
Yeah.
What are the sentiments that you're drawing from the performance?
I think with Kenya Airways, again, it goes back to the story of an attractive industry. I think anybody who's been looking at the airline industry over time would probably have seen, they have the same story. You have the compression of margins. I think they're facing quite a bit of, competition just regionally, which is probably their most profitable line versus when they want to go and take on the big boys, flying to Europe and China and what have you. So I think the industry itself is unattractive. I think their financing decisions have always been in doubt, and then they have the fact that labor constraints to the effect that you actually have a very strong union that sort of always is going at them, collective bargaining agreements with the pilots. Recently there was an issue in the news where they were actually going to court to try and delay payments of salaries to their new pilots. So I think when you see all this falling into place, you start getting the sense that it will really take perhaps some very high level reorganization to actually get the company at a level where it's generating sustainable and stable profits.
This year we've seen Kenya Airways coming in with a lot of new routes, mainly focusing on Africa and the Far East. And of course we have had the numbers in the European market. The routes have not been performing as well. Is Africa the new strategy they actually need to focus on and hopefully try and turn around their company?
Yeah, I think one common story that is always told is that because of the geography of Africa, you have countries quite close to each other. It's normally a very, more or less easy route to play. I think the key with Kenya Airways would be in terms of strategy going forward, how they could actually, sort of diversify their business, and the fact that they're actually concentrating on Africa is good, because relatively they have some competitive advantage over other, sort of players. Again, it comes back to the question of your financing decision and how you've been able to manage your debt side at the same time, keep your shareholders happy, and the sort of returns that you can get on that. I think this year and probably within the next financial year, they'll have the benefit of fuel prices again, with the oil price being relatively stable and lower than what we've seen historically. That would probably impact them well, as far as the expenses are concerned. But the question is, again, if you have a slowdown in the global economy, are you able to fill your jets? Are you able to get, your load factors up? Are you able to, for example, to move as much cargo as you had anticipated to? And obviously that's going to contribute to the bottom line.
How bad is the gearing ratio?
How bad is the gearing ratio? I mean, I think just based on the recent data they took, I don't have the numbers off the top of my head, but I think, there was a question about whether they would actually be able to service their debt if we project their cash flows forward over the next 2 to 3 years. And that has always been a key concern with some ideas that maybe they may actually have to come back to the market to ask for some additional equity to be able to balance that out. You want to leverage your book when you're actually making money, as we measure that by your return on equity. If, for example, that is constrained, then leverage is actually only just magnifying the negative returns to your shareholders. And the question is whether they'd be able to put up with that for much longer. All
right, and finally on Kenya Airways, they are trading at a PE of 3 shillings against an industry of about 10.9. For you, what are your thoughts on that?
It would be interesting to look at it in terms of an industry perspective. If we look at comparables, so I'd want to look at the multiples for other listed, airlines, and then compare that. It obviously looks cheap if you just take that and look at it versus the market. It would probably be a speculative play on earnings, coming forward. But it's not really something that I would look at myself. Yeah, that's just my position.
All right. Uchumi is one of the stocks that on Friday dragged down the main share index. And this is a stock that has also been looking to get into the market to borrow some money to diversify into the regional market. And it is actually trading at a PE of about 19 against a PE of 10. What are your thoughts on this stock?
I think one thing the foreign investors have found short of in this particular market has been exposure to consumer staples. So the sort of stocks that they've been buying have been, your East African breweries and your BATs, and maybe the only other stocks, if you talk about the GICS sector classifications, then maybe you might look at Uchumi as giving you exposure to that particular market. So being the only listed, sort of like retail chain, then obviously they benefited from that. In terms of whether the stock is attractive at these current PE levels, I think it's a bit. You probably want to look at Game and ShopRite, for example, in South Africa, and other comparables across the board and think whether actually Uchumi would, justify those particular multiples. I think the key with Uchumi is to try and back out what the fundamentals are saying. So for example, the implied growth rate. Now that you have inflation slowing down, what does that mean for the company's top line? They're trying to raise some additional capital. What does that mean for margins? Are they going to, going into another expansion spree? If you walk into the supermarket itself, what sort of feeling do you get when when you're shopping at the tills and you compare that to other competitors, and do you really think that this is something that's going forward? I mean, are there no frills, or are they just, just trying to have the basics for the particular consumer?
So it's a stock that we would need to watch in the context of Africa. Yeah,
it's a stock. You may think that you're actually playing the growth story by buying into Uchumi. I think that's debatable. At the current PE levels, you probably want to ask yourself whether this can be sustained in the long run. But it's not particularly a stock that I'd want to hold on to if in current market conditions, and if you really expect the market to turn.